Welcome back. Let's take a look at futures this morning, where we are expecting a decline at the start of trading. Futures indicating a decline of about 150 points on the Dow Industrials. The Dow right now down 146, the Nasdaq down 79, and the S&P 500 down 22. Of course, we are approaching the end of the third quarter. Markets down across the board since July on the last trading week of September and the end of the third quarter. Moody's is also warning that the United States risks losing its top credit rating if the government shuts down over the weekend, next weekend. Joining me right now is Potomac Wealth Advisors founder and President Mark Avallone. Mark, great to see you. Thanks for being here. Are markets focused on the potential of a government shutdown yet?
Yeah, I think it's starting to become more of a reality. There's plenty of other things we're concerned about. And then to layer this uncertainty just adds more concern for investors. Look, we've already had a market that's looking at close to $100 oil in a few weeks if this trend continues. We have wage hike spirals that are going to crimp the bottom lines of corporations. There has been an undertow of increasing regulation out of Washington and an anti-business mood. M&A activity has been stifled. So it's hard for markets to get optimistic and to find a catalyst when all the macro factors seem to be weighing against investors and against economic growth.
Yeah, I think you've laid out a pretty good list there of challenges. We've also got a big week of economic data this week. We'll get the July Case-Shiller Home Price Index out at 9 a.m. Eastern today, and then the August new home sales out at 10 a.m. Eastern. We're also waiting on the final read, rather, of the second quarter GDP. That's out on Thursday, and the August PCE index out on Friday. Mark, you just mentioned oil prices. Oil now around $90 a barrel, sort of undermining any decline in inflation. It's going to keep it up there, right? What are you expecting from all these numbers this week? And how would you assess the inflation backdrop?
Well, there's so much there. I mean, oil to be rising while interest rates are rising and the economy is slowing is certainly not good news. It's not good for consumers who are facing higher prices still. I know the headline inflation number comes down, but that excludes food and energy. So talk to people who are using food and energy, and they're going to tell you inflation's not coming down. But the Fed is also raising rates, which raises the cost of buying a home, raises the cost of buying a car, and any extension of credit. All of these create economic slowdowns. Look, the oil price hikes are something that we had under our control when we stifled exploration and we did not continue a robust energy strategy. We laid the groundwork for this. And who benefits? Russia benefits from higher oil prices. Overseas countries benefit from higher oil prices. And we import from overseas instead of producing here. So this conundrum of having higher oil prices with higher interest rates and a slowing economy does not bode well for consumers, and it's also an overhang for stocks.
Yeah, and as you say, it goes back to bad policy. Rebecca, jump in here, because the spike in interest rates also goes back to bad policy. I'm sure you saw the Journal story. Americans finally starting to feel the sting from the Fed's rate hikes, 11 rate hikes. We're talking about 7% plus mortgage rates and higher rates overall, expected to cut into growth. Rebecca, jump in.
You know, Maria, it really concerns me when the Fed held rates last week, but they updated their economic quarterly projections. And it's still very hawkish. So we're looking and expecting them to potentially even raise. We obviously have had Fed members say that there's still potentially going to be a raise, looking at the dot plot. So while oil is tightening, we know Saudi Prince MBS wants it at $100 a barrel for his economic policies and what he wants to implement. But this is recessionary times. Germany has been in a depression really for the last 6 months in their manufacturing. That's affecting the Eurozone. It's affecting Asia, and it is coming here. So we cannot be, sort of out of touch with what's really happening, no matter what people are saying. People are feeling it in their pocketbooks, especially, Maria, when the student loans restart next month.
Yeah, for sure. And I guess final question for you, Mark, is what does this all mean for earnings? Because after we get through this week and a potential government shutdown, we'll be focused on third quarter earnings, which will begin in about 2 weeks with the quarter ending on the 30th. Is this inflation and slower growth story going to cut into profits for the third quarter?
Well, it will, and it's going to vary industry by industry, of course. Oil prices are going to hurt transportation earnings, and you can hedge for a certain period of time, but after that, it's difficult. Higher wages are going to hurt across the board. Look, it's not just a handful of unions that are getting 8, 9, 10% raises. It's people who are other non-organized groups and companies that want to head off unionization that are paying. And there's an inverse relationship between wages and stock prices. So that's going to hurt. And higher interest rates are going to hurt corporate bottom lines. Any company going to the debt market now is going to pay exponentially higher than it did just a few months ago, and certainly a year ago or longer. So those are three headwinds against profits. Profits are the #1 driver of stock prices. So we need to keep our eye on the ball in terms of what's going to affect the investor results. And we think earnings are always the biggest driver. And right now, those three factors are working against them.
All right, we will be watching the quarterly numbers and, of course, the beginning of the fourth quarter next week. Mark, thank you. Mark Avallone joining us this morning.